Alibaba shares are down another 2.25% a day after they reported Q2 results. And now I'm actually starting to see some YouTubers come out and say that they are dumping the shares. Is that a good idea? I personally don't think so. Let's get into it. You're watching More Money. Let's get it. So guys, you might have noticed today that Alibaba's shares are down by another 2.25%, which I thought was pretty interesting because generally after a huge decline like we saw on Thursday when they reported the results, you'd expect a bit of a bounce, but we didn't really see that. So I think what's happening is people are digesting the results and really saying, hey, you know what? It's too much. I'm out. Now, the first couple of issues, of course, are the challenges that we're experiencing in China. And these are well documented. If you've been following this channel for any length of time, you would see me explaining these. The first, of course, is the rolling blackouts or the power crisis that they're experiencing in China. They've already started addressing this. The Chinese government took an all hands on deck approach. They're importing more coal and mining more coal as well. And the power producers are at full capacity, or at least starting to become full capacity. So I only see a near-term impact from the power crisis, not a long-term one here. So it's not a reason why I would sell the shares. Now with the real estate crisis, the Chinese government really has been mute somewhat with respect to how they're gonna handle this. They did say that the Evergrande is not too big to fail, but if there's a pervasive impact to the economy, they're gonna have to step in. The other issue and the bigger issue that I think is gonna happen here, and it's actually coming out in my Evergrande series that I'm releasing soon, is that there's a misalignment of the incentive structure with local governments. They get a lot of their tax revenues from selling land leases. The Chinese government is really gonna have to step in, bring in a property tax, and change this incentive structure, because what you're really doing is you're forcing local governments to be incentivized to sell more land, to build more houses on, and so you end up with 65 million unsold homes in locations that are less desirable in the major cities. So there's an incentive structure there. They are looking into it. They are trying to roll out a property tax. So that's something to watch here, but not a reason why I would sell Alibaba. And the final challenge that I think China is experiencing right now is that they're getting resurgences of COVID. Now, part of that is that the Chinese vaccines were not as good as the North American developed ones, at least as it related to the Delta variant. So they are relocking down certain areas. That being said, vaccines are getting better, therapeutics are getting better, and I think that this is a worst case scenario, a near-term issue, not a long-term issue. So why you would sell Alibaba because of that, I don't understand, but you know, let's see how this rolls out. I think there's only good news that is going to be coming out from this as time goes on, like we're seeing everywhere else in the world. Now, if it's the results that are scaring people, I don't really see why. Now, personally, I actually think that the business did better than what I was expecting, considering all of the challenges that I previously mentioned. I thought that there'd be worse impacts to the business overall because of the power shortages, the COVID lockdowns and such. So to be honest, I actually believe that the business outperformed. That being said, I do expect that some of these impacts could fall into Q3. So I wouldn't be surprised if I saw a worse Q3, especially in light of year over year comparison, because in Q3 of last year, you would have had the holiday buying season. And so now that we have larger supply chain issues, you could have a lower holiday buying season this year relative to last year. So I could expect a worse Q3. That being said, still not deterred here, because overall, long term, this business is sound. I'm not scared of short-term supply chain issues, at least not yet. Now, of course, their revenue guidance for 2022, I think, was really good. They're forecasting revenue overall to grow at around 20 to 23%. If you look in the model, which I gave to you guys months ago, we forecasted total revenue growth of around 20 to 21% over the next 5 years. So they're really in line with that expectation. And what I really think is going to happen is once you eliminate these situations and you move forward into 2023, 2024, this could potentially pick up for them, whereas our model still models it at the same 20%. So I think there's some upside here. Now guys, my valuation remains the same. It's still at approximately $350 a share. The share price actually declined down to $140 a share. So it's a really compelling opportunity. I'm largely looking at the $100 cash secured puts and seeing if I can catch a yield of around 20 to 25%. I largely don't want to increase my position because I have a really good position, but if I could potentially bring down the cost basis using cash secured puts, I would do that. And worst case scenario, if I have to buy the shares at a net purchase price of 75 bucks, happy to do that. Now guys, the situation that's occurring in China, I actually made a video on this, which you can grab right here, where I talk about those 3 issues that are really impacting China and why economists are reducing the near-term growth targets for China. It's not a long-term thing, it is a short-term thing. So you can grab that video right here. And guys, if you're new, I hope I really earned your subscription today. And if you're returning, please smash that like button. It really helps YouTube know that this channel provides valuable content, and then they'll share it with more viewers. That's it for today, guys. I'll see you later.